Dividend growth investors, bonjour, Mike Hiru here, founder of Dividend Stocks Rock, and also the author of this YouTube channel that helps you invest with more conviction so you can enjoy your retirement. Welcome to this 2023 market recap where we're going to look at what happened this year and what's gonna happen in 2024. It is actually right before New Year that we're doing that, and just to let you know that between January 1st and January 6th, I'm going to publish one video per day helping you to invest a lump sum payment in 2024. I know a lot of you guys are waiting on the sideline. You're not too sure about what's going on. And especially with 23, that was all over the place. You're still filled with uncertainties and paralyzed by analysis. So I'm going to offer you this quick series to ensure that you have a little more conviction and you have a plan to start a year on the right foot. So today we're gonna look at what happened on the stock market. So it was a pretty strange year. A lot of investors told me, oh, that was not that great of a year, especially before we had the latest information about the CPI in the US. And then Central Bank of Canada, the Fed said in December, we're not going to increase rates. And then boom, all stocks started to rise. But right before that, if you were focusing on income investment such as higher yield, like 5-6% yield, that was a difficult moment to go through. 2022 wasn't that great. 2023 not that much either. And a lot of people would say, yeah, but Mike, how about investing in GICs instead? And then I would like, well, look at what just happened over there. So if you stay invested and you focus on your strategy and you stand that volatility over time, it's not that bad. Obviously, a big portion of those stock returns have been generated by technology sector or any tech-related stocks, because now if you think about the communication services, you're going to find companies like Alphabet, Google, and Meta that are part of that. Obviously, they're more technology stock than anything else, but still a little bit elsewhere. And a great part of the S&P 500 and the NASDAQ strong year was just fueled by that. Keep also in mind that in 2022, the technology sector got hurt like there's no tomorrow. So always important to put that into perspective when you're just looking at 12 months. That is a short-term period. For the Canadian market, it was pretty much like all the way up, not all the way up, but like pretty much steady for the most of the year. And towards the end, we just made a big push, mostly because we are finally getting closer to that time where potentially we're not going to see more interest rate increases. Moving on to specific sectors, as you can see, the losers of 22 are the winners of 23. It's not always that way, but most of the time there is a movement of balance where the market goes a little bit too much on the left and then a little bit too much on the right. So while the big losers were technology sector, communication services, and consumer discretionary in 22, now they're the big winners. Interestingly, we only have we can say 4 sectors that are negative, but I mean healthcare at minus 0.05 is not really negative. But then we have the energy sectors that went sideways a little bit, mostly because the peak of the oil barrel was actually during the summer of 22, and in 23 wasn't that great. It's going up, it's going down. I mean, there's no surprise here. If you're surprised to see the oil barrel going all the way up and all the way down year after year, you haven't followed the market for a long time. It's always the same thing with commodities, and it is what it is when you invest in those sectors. So the key is really to make sure that you're able to buy at the bottom and sell at the highest price at the peak, which apparently was in 22. A lot of bull energy investors will tell you that the best is yet to come, but they're going to tell you that every single year. So I'm still skeptical. And honestly, since I focus on dividend growers, there are not that many growers in that sector anyway. Another one that got hurt, consumer staples. I mean, pretty stable overall, not big movements. A lot of the food industry, when we're talking about like snacks and beverages, have been hurt by the rise of Ozempic and other weight loss drugs. So that is also something that is weighing a little bit on our stuff. And then you have the utility sectors that is capital intensive, has a lot of debt, and all the renewables, they just crash and burns. But we're going to talk about that a little bit more during the series that I will start on January 1st. So we're going to talk about those sectors a little bit more later on. So today is more about to have like the global picture of what's going on. When you look at the US consumer sentiment, this is something that I like to see because it tells us a lot about how people will have their intention to spend their money going forward. Are they going to go on vacation? Are they going to buy a new car? Are they going to do some major home renovation or simply just buy a new home to upgrade? Well, as you can see, I mean, we're getting a little bit better for the consumer sentiment towards the end of the year. Again, linked to those news around inflation getting slowly back under control and having the interest rate going to probably not increase anymore and potentially being cut in 2024. So then consumers are just like, yeah, maybe we're going to spend a little bit more. But when you put that in perspective and you look at the past few years before, we're still not in the mode where people are like super confident and are going to spend a lot. I think that a lot of consumers will focus on paying down their debts and trying to get their budget in check. Another sign that we are not in full growth mode is the housing starts. You know, the construction business, both in Canada and the US, is a great indicator of how the economy is going because it generates a lot of work, and those people that are working, they spending a lot of money as well. So when you see that the housing starts has slowed down starting in 22 in both countries, again due to the interest rates, and now it's pretty much stable, but we're not necessarily see an uptrend. Actually, in Canada, it's going down. We got a small bump in the US, so nothing to scream that the economy is going to be booming in 24. But so far, it is not that bad actually. Both Central Bank of Canada and the Fed wanted to have a smooth landing, and it seems that we have some chances of happening, but between you and me, I don't believe in that. I think we're still going to get a recession, but we're going to talk about that later on in this video. Before we talk about recession, let's talk about unemployment rate. And actually, it is not doing that bad, right? So we see that there's this slightly going up trend for Canada, but in the US, it's pretty close to the lowest level that you can have, because obviously there's always people that are going to be looking for jobs no matter how many jobs there is on the market. So you don't have necessarily the right qualification. There's a sector difference. There's a lot of like difference that will explain that you cannot have a zero unemployment rate, but when you're at like less than 4%, you can say that your economy is booming, that is going well. So we have a very interesting phenomenon right now. While a lot of companies are announcing you that they're gonna cut jobs, lay off a bunch of workers, we also have a lot of people that are going to retirement and not enough young people coming to the workforce. So there's a debalance right now because of our demographic that will continue to push a little bit the wages a little higher, because there will still be a shortage of labor for a lot in a lot of sectors. So as you can see on this graph, it is still going pretty solid in terms of the workforce and the employment. So once again, we may not get into a deep recession. Probably the most interesting graph at this point, this is the overnight interest rate for both Canada and the US, again to see what are the trends. And I put everything since the year 2000, because I wanted to show you that back in the day, 23 years ago, interest rates were slightly higher than what we have right now. And we went back right before the financial crisis, it was pretty much at the same level. So not exactly for Canada, but we're still among those lines. And since then, we went through more than 10 years of a low interest rate environment. So what's gonna happen next? Well, I expect that we're gonna have probably like a small plateau of a few quarters maximum. Now we have a pretty strong signal that both Central Bank of Canada and the Fed have their intention of cutting down their rates in 24 if the inflation continues to be under control. So that will be the key thing to follow next year among economic data. Look at the housing starts, look at the consumer sentiment, look at the unemployment rate, look at the GDP, and finally, making sure that inflation is still in check. Right now we're around 3%. It's still not that great. It's still a little bit higher than the target for both central banks, but we are getting there, and there's a pretty big chance that we're gonna get there in early 2024. So those will be the metrics to follow. So are we going to have that recession in 2024? It's kind of funny because, you know, at the end of 22, around October of 22, Bloomberg did a survey among a bunch of economists and analysts and asked them, like, do you really think that there will be a recession in the US for 23? And 100% of those analysts said there will be a recession in 23. And you know what? If I would have been surveyed, but I'm not that important for Bloomberg, but if I would have surveyed, I would have said the same thing. I was convinced that we would have a recession in 23. This is not happening, even though we can see that in Canada, we're not growing that much anymore, but still the US economy is incredibly resilient right now. And it seems that we're still on that track. We're gonna avoid that recession. So on my side, I still believe that we're going to go into a recession in 2024. Hopefully it's not going to be a big one, but in the end, it doesn't mean that I'm going to stop investing. Actually, I'm going to keep my portfolio as is because I did some strong spring cleaning inside my portfolio throughout the entire year of 23, just to make sure that my portfolio and my investments are still in a good position to weather any kind of storms. But whether or not you believe there will be a recession, you still need to get your portfolio ready. And the best way to do it is to stay invested, is to invest in a good way according to your profile, according to your goals. And during the series that we're going to have next week, this is what we're going to talk about, is how to invest that money waiting on the sideline. I also have another big announcement to do, is that we will have a webinar on how to invest in 2024. This is like the most popular webinar of the year. Last year we had more than 1,500 investors that registered for the webinars. It's always a great place where we can do a market recap, we can talk about investment teams for 2024, and how you can make those small tweaks to your portfolio to make it better. So the webinar will be on Wednesday, January the 10th at 1 p.m. Eastern Time. You can click on the link description below to subscribe. It is 100% free. You just put there your name and your email, and you will see the replay if you cannot attend the live event. So super important, if you want to watch the replay, you have to register to the webinar, and then you're going to receive it automatically. So all right, investors, take good care, and don't forget, new series coming up on January 1st. So give me a like, subscribe to the channel not to miss this series, because I think it's going to be a very good thing for you to start the year on the right foot. All right, so we're going to talk again in the next year, and until then, don't forget to stay invested.